and investor uses. Now we're going to divide this learning module, which is the third learning module of level 1 derivatives, in 3 videos. In the first video, we're going to cover the introduction and the benefits. In the second video, we're going to cover the risks. And in the third video, we're going to compare and contrast the use of derivatives by issuers and investors. So let's get started with the introduction and then we'll get into the benefits. So this reading covers the benefits and risks of using derivatives. It also covers the comparison of how issuers use derivatives versus investors. As far as benefits are concerned, which we are going to cover in this video, we're going to categorize them into 4 different types of benefits. And we will be covering each of these in separate slides now. Now, starting with the first one, which is risk allocation, transfer, and management, I want to talk a little bit about the difference in issuers and the difference in investors. Rather, actually, I want to talk about the way they use derivatives. So I want to talk about hedging versus speculation. Now, if you are an airline and you sell airline tickets and you're worried the oil price might go up and you're buying oil in advance from now so that you can issue tickets for next year's flights, this is an example of hedging. Or let's say you are an oil refinery which needs to buy crude oil and it's just locking in its crude oil prices for next year. Or you are a jewelry manufacturer and you're just locking in the gold price for jewelry manufacturer. Or another example I can give you is, let's say you are a copper wire manufacturer and you want to lock in the copper price for a large construction project which will require lots of copper wire, right? However, on the other side, we have investors who think oil price might go up or down, who think gold price might go up or down, and this is speculation, right? Or who think copper price might go up or down, or who think the stock market might go up or down. So this is all speculation, and investors do investment and part of what they do is speculation. So they have a different use and therefore different benefits they get from derivatives. And issuers are usually businesses that are just trying to manage their risk so that they don't have any unexpected losses in the future. Now, issuers are usually manufacturers, right? And they may need to order commodity inputs. And I gave you the example of copper. Let's say we are talking about a copper wire manufacturer. And they have this huge construction project in the future and they want to order the copper from now so that they can lock the prices and quote for that project. Or it could be a retailer. So let's say Walmart in the US is awaiting a shipment of Gucci bags from France, right? And Gucci has sold those bags in euros, and obviously Walmart is going to pay in dollars. They're going to use those dollars to convert and buy euros. So by the time the shipment reaches, the change in exchange rate between euro and dollar might change the whole cost of the product. So what Walmart could do is use a derivative to lock the conversion rate of euro to dollar the minute they do the purchase. And in this first point, this copper wire manufacturer could use the derivatives copper market to lock the purchase price of copper in the future. And in the previous video, you might remember that we talked about Emaar, which is the construction company for Burj Khalifa, and they have a bond payment. They had raised some finance using bonds, and they have a big bond payment coming up, let's say, right, which is the face value payment, the par value payment. The original amount is being paid back. So they're afraid that they might not have enough cash to pay that back. I'm just giving an example. Obviously, Mart probably does have more than enough cash they require for their liabilities, but just giving an example is that in case they feel that they don't have enough cash, then what they could do is they could lock a loan in advance equal to this bond payment, lock a loan in advance from a bank through a derivative, which is called a forward rate agreement. And that is something you will learn in a later video, that how you can lock a loan in advance and even lock the rate for it. Investors who are looking to speculate may use the very interesting feature of derivatives called leverage. And why that is the case is because derivatives, they are just contracts. You're not actually buying the underlying asset. So since you're just getting into a contract, so the amount of cash required is much less than actually buying the asset. Now, if there is an investor who seeks to buy an asset, or let's say they want to invest in the stock market because they think the stock market might go up, right, but they don't have the necessary cash, they lack the necessary cash, so what they could do is they could use derivatives to invest and take a much bigger position than they would otherwise be able to in the spot market. Or let's say there is an investor that is anticipating that in future there's going to be a dividend coming to them, or a coupon payment coming to them, or a principal repayment coming to them, and they want to invest from now. So those the reinvestment of the proceeds in future can be done from now, because derivatives don't require cash or require very little cash. So this is again an interesting benefit from the perspective of investors. So what happens is that basically you're locking the price now for a future date, and you use this facility of derivatives to bridge this timing gap, right? And again, the same example, if that the investor has a bullish view on the market but lacks the cash to transact, then he or she can purchase a forward contract or even a call option. So with respect to derivatives, you have firm commitments and contingent claims. So firm commitment would be a forward contract, or a contingent claim could be a call option, as we have discussed in previous videos. And they can use these derivatives to use very little cash and benefit from their view, and if they're right. But if they are wrong, in the case of the call option, they'll lose a little bit of a premium, but in the case of a forward, they're going to lose a lot more, right? So I hope you understand that by now. Derivatives allow users to create exposure profiles which are unavailable in cash markets, right? So which not only means that they can use very little money to create this exposure, but also you can create short positions, which means you can make money when the market goes down. So you can have a put option, which means if the stock is going down, you will make money because you have the right to sell at a certain price. You can short the forward, right? So this is something which is available in the derivatives market. Another very interesting position is the covered call position, and let me give you an example here. Let's say we're talking about the Saudi Public Investment Fund, and they are required, or they want to invest in the shares of Aramco. Now they've got these huge shares of Aramco, they've got this huge holding of Aramco shares, and those shares are not going anywhere, right? So what they could do is they could start selling, or another word is writing, or another word is shorting call options, which means they are basically selling the right to others to buy Aramco shares at a certain price, and for which they will be receiving a premium. So their Aramco shares are just sitting there, and if, for example, the shares do go up and people do come calling and saying, okay, we've bought your call options and we want to buy Aramco shares, so no problem, they're getting a decent price for their shares, because they're usually going, if in this kind of a covered call strategy, the exercise price is usually very high. So even if people do come calling saying that, oh, we want to buy shares because the share has gone even above the exercise price, then you will still be happy because you'll get a decent price. And even if they don't come calling, if the share doesn't go up, then at least you're getting the premium. Either way, you've you've got the shares with you. So even if they do come calling, you have the shares, and hence the word covered. So it is a call option that you're selling and you're already covered. So it's called a covered call position. The second category of benefits is information discovery, which in itself has two subcategories. Number one is price discovery. Now, what happens here is that because derivative markets are very, very active and in both directions, so buyers are active and sellers or short sellers are active, and usually it helps us figure out that where cash markets are going to go, especially if you look at the treasury futures, which are extremely liquid. The treasury futures, they can even tell you where the future benchmark interest rate is going to be going. So it helps in price discovery. The other thing is implied volatility, and this also works backwards from what the market participants are expecting. So this is based on actually the volatility of an options price. So whatever stock option is available in the market, the price of that might be going up and down. So based on that option price volatility and using models like the Black-Scholes-Mertle model, what we are able to do is calculate the implied volatility. And it's like working backwards, but either way, the point is derivatives markets help us to kind of put a value on the amount of risk there is in a certain asset. The third category is operational advantages. Now, lower transaction cost, and why that is, and a lot of this is linked to shorting of the market. So first, let me first talk about lower transaction cost, and practically speaking, how this happens is that, a lot of people, they don't really get into a derivative position to actually get the underlying asset. So if I'm, let's say, going long a derivative, my intention might not be to actually get the underlying asset. My intention might be to just make a quick return and go short and close the position. So because the actual underlying asset is not changing hands, the actual transaction costs are very low. So therefore, the overall transaction costs in derivative markets are much lower than the underlying market, because people are not actually trading assets. The assets are not changing hand. They are just contracts to buy and contracts to sell, canceling the contracts to buy. And therefore the transaction costs are lower. And where people are taking contracts to buy, people are also taking contracts to sell or taking short positions. So it makes it easier to take the long positions, because there are more people taking short positions, which is not there as much in the spot markets. So therefore it gives you a greater liquidity than the underlying spot markets, because the buyers, they get their opposite parties, which are the sellers. So, and obviously the sellers are able to easily take a short position as well. And again, of course, cash is 100% cash is not required. You can operate on margin, right? Options only require premiums, and therefore the cost of overall operation is much less compared to the actual cash markets. Now, the last category here is your market efficiency, the last category for the benefits. And because derivative markets offer less costly ways in order to exploit the mispricings in the market, what happens is that people quickly exploit those opportunities. And because the transaction costs are low, easier to take the short position. So if the market is going up quickly, people will come and they'll start short selling and they'll bring the market down. Or if the market is going down, people will come and start buying and take the market up. And it will make the market more efficient, right? So it does make the market more efficient, because any mispricing is corrected more quickly in the derivatives market than it is in the spot market. However, it has been seen that the existence of derivatives market causes financial markets in general to function more efficiently on one side, but there is evidence that there is a lot of speculation because of it, and we will get into that when we talk about the risks. So this is the last for this benefits, and I'm going to summarize the benefits, and then in the next video we'll get into the risks. So as far as the risk allocation, transfer and management is concerned, right? You can do all of this without trading the underlying. So you can allocate risk, you can transfer risk, you can manage risk, and without actually having to buy or sell the underlying asset. You can even do such exposures, create exposures which are unavailable in the cash market. As far as information discovery is concerned, you can deliver the expected price in the future, which is basically knowing based on the derivative market price what will be the price of the spot market, as well as the expected risk of the underlying, which is basically the concept of implied volatility that we talked about, that you take the option price and then you put it into the Black-Scholes Merton model, and then it tells you what is the implied volatility, which is basically the risk of the expected risk of the underlying. In terms of operational advantages, we talked about number one, that the cash outlay is reduced, there are lower transaction costs, right, increased liquidity, and the ability to short. And in terms of market efficiency, because they are so low cost, therefore people are able to exploit inefficiencies in the market and mispricing in the market and quickly make the market more efficient. So that is the end of this video, in which we covered the benefits of derivatives. In the next one we will cover the risks.